There are some obvious places to invest your money, like the S&P 500, and then there are some not so obvious places where you can invest your money, which also have big profit potential. And that's why in this video, my goal is to show you 3.5 underrated investment opportunities that you can consider. But first, you have to understand how risk and reward play a factor when it comes to your investments. The general rule is more risk, more potential return, more reward. And you want to understand the different types of opportunities that there are. For example, low risk, low return opportunities will be something like saving your money in the bank. Low risk, high return opportunities would be like investing your money into the S&P 500 when you're in a recession. You remember during the COVID pandemic and every other recession, when you see a market crash, markets go down, and that could be a great buying opportunity to come in and buy the economy at a big discount. But those opportunities are pretty rare. So these are harder to find opportunities. Then we have the high risk, low reward opportunities, which is the one you want to avoid. This would be something like throwing your money into penny stocks. Very high risk, but the chances of you making any money are pretty low. And then we have higher risk opportunities, higher potential returns, which is what we're going to be talking about today. These are things where you're going to go out, put in more work, but you also have the potential to earn more money. Now that we've laid the foundation, let me talk about the 3.5 unique investment opportunities that you can consider, starting with number 1, finding unique market shifts. Now, all the data that I'm about to show you is from my Market Briefs Pro team. That's the investor research arm of my Briefs Media company. But when you invest your money in the stock market, what you want to look for is where the money is moving to, not where the money is moving out of. That's how you find real opportunity, because you wanted to go where the economy is going, not where the economy was. And this is where what you want to look for is what are shifts that are happening in our economy or in markets that could potentially create an investment opportunity. And there's a few that I want to go over today, particularly talking about data centers and what's changing there, going over what's happening with water, and number 3, what's going on with NIM, net interest margins, and how these can create potential investment opportunities. But I got to remind you, I'm not telling you what to invest in. I'm just showing you some things that are happening to spark that investment part of your brain. That way you start looking for investment opportunities in the economy around you. And I am not telling you what to do because, well, I'm just a random guy on YouTube. I'm not a financial advisor. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. So let me break this down. So starting with data centers, we know that more and more people are using their phones. They're using technology to save things on the cloud. My phone today has a terabyte of storage on it, but I still use my iCloud backup. So I have stuff that's being saved on the cloud. If you have anything that's saved on the cloud, what that means is it's actually stored somewhere physical, and that physical place is a data center. Not to mention, we've seen a big growth in artificial intelligence, AI, and with the growth in AI also comes more storage for that AI, which is being stored in data centers. Now, this is where you have some investors that will say, oh, because more people are saving things in data centers, I'm gonna go invest in data centers. And sure, that could be one potential investment opportunity for you, but you can also dig a little bit deeper because there's more to it than that. For example, those data centers need a lot of energy to operate 24 hours a day. That could also create a potential investment opportunity. Not to mention that there are specific companies that specialize in data center energy. But that's not all. These data centers need to be kept at a certain temperature because they have all this hardware, all this technology that's operating, that's creating heat. And so they need specific technology to cool the data centers, to cool the technology down. And there are specific data center cooling technologies, specific data center cooling companies that are involved in cooling the technology down, because if that data center gets too hot, ChatGPT could die. So let's think through this analysis like an investor. If more and more stuff is going to be stored on the cloud and there's going to be more AI usage, that could create more demand for things like data centers, which could also mean that there's more energy needed for those data centers and more cooling technologies. These could create potential investment opportunities, assuming that that trend continues. But you have to also understand that there are specific companies within this niche that could do good, that could also do bad. For example, there could be data center companies that are very bad with their cash and they could go bankrupt. There could be cooling companies that have a bad technology and get sued and they go bankrupt. And so this is where you have to understand the risks, not to mention the fact that if we see a recession start tomorrow, that could completely change the economy. So you want to understand where the opportunities are, where the money's moving, but also understand the risks. That way you can analyze what's happening and then make a decision based off of what's right for you. Another example of this to help you think like an investor would be water. So my Market Briefs Pro team went out and they interviewed BlackRock. And what BlackRock said when it came to water is that there is a finite supply of water in the world, but a growing demand for water because everybody needs water. So then we did some more digging. What did we find? That you have a lot of big institutions like BlackRock, who is the largest money manager in the world, that are going out and buying/investing in companies that are related to water. That includes water infrastructure companies. That also includes water treatment companies, because they understand that there's a limited demand here, because they're looking at the water industry for the next 10, 20, 100 years saying, what's going to happen to the water industry as there's more people, as there's more need for water, while the supply of water doesn't change? And so that's one of the reasons why they're investing in that. Could that create a potential investment opportunity for you? Maybe. Again, it depends on your goals, depends on your risk, depends on what you want to invest in, but now you're starting to think like an investor. By the way, if you want to stay up to date on what's happening in the financial markets, my team at Briefs Media publishes a free newsletter called Market Briefs, where we go over what's happening in things like the economy, the stock market, the housing market, the crypto market, and the global economy into a fun and witty and easy to read newsletter. We have hundreds of thousands of investors that read Market Briefs every single morning, and you can read it in less than 5 minutes every day. So if you want to stay up to date on what's happening, I got the link for you to join Market Briefs down in the description below. And then if you decide later on that you want a little bit more investment research, kind of like the things that I'm showing you here, well, then you can consider upgrading to one of our Brief Pro plans, where you can get access to much deeper investment reports going over shifts that are happening in our economy. And then the third example that I want to show you to help you think like an investor has to do with NIM. Net interest margins. And the reason why I want to talk about this one specifically is because I made a video talking about this last year in 2024, and now we're starting to see the impacts of this today. Here's what happened and what's going on. In 2024, the Federal Reserve Bank cut interest rates multiple times, but in 2024, we also saw mortgage rates go up. What does that mean? Well, if I diagram it out for you, here's what's going on. You go to the bank to borrow money. For my male followers, I drew a mustache, which in my native language Punjabi we call a much. My female followers, I drew a braid, which in my native language Punjabi we call a gut. You go to the bank and you want to borrow money. This is called your mortgage rate. This is the rate that you're paying. This is the retail rate that the bank is charging you. But the bank is borrowing money at a different rate. The bank is borrowing money at what's called the federal funds rate. So they can borrow money from other banks at the federal funds rate. This is what the Federal Reserve Bank is setting. So in 2024, the Federal Reserve Bank lowered the federal funds rate multiple times. But over the year in 2024, your mortgage rate went up, which means this margin on the cost the banks are paying to buy that money and the rate at which banks are selling you that money at your mortgage rate went up. So this net interest margin went up, which helped some banks make more money in 2024. Take a look. In early January 2025, JP Morgan Chase Bank said that they made more profit than ever before in 2024. Not just that, they also broke a record for how much money a bank has ever made in America in 1 year in the history of time. Maybe this net interest margin had something to do with that. Plus, many other banks also saw huge profits in 2024, which might have something to do partially because of this. So the first underrated opportunity is to be more involved with the research and to look for where money is moving. Yes, this comes with more risk, but it also comes with more potential return. And what this means is you want to understand where the money is moving to, because that could potentially create an opportunity. But there's a couple of things that I want you to remember. Number one, there's risk. There's risk that maybe the money won't move into the industry that you thought. And then you also have the risk that maybe the company that you're investing in is not doing a good job. And then you have the last layer of risk is, well, we could see a recession, or we could see a broad market thing happen, which hurts the broad economy, which could also hurt your stock. That's why I say that this is one of those higher risk, higher potential reward opportunities. It's not guaranteed return, it's higher potential return. And there's one last thing I want to remind you before we move on to opportunity number 2. When I try to identify a good investment opportunity, I'm looking for 3 different things. Number 1, it has to be a legal investment. Number 2, it has to make financial sense, meaning I have the opportunity to make money. It's not guaranteed, but the opportunity. But number 3, it also has to make moral sense for me. I'm not going to be the judge of your moral compass, but it's something you want to think about. Because just because something is a good investment for somebody else may or may not be a good investment for you. I'm not going to tell you what you need to believe or what you shouldn't believe, but it's something you want to factor into your own investment plan, because it's up to you to decide your moral compass. And with that, let's move on to number 2, real estate for tax benefits. Now I'm going to set the stage here to really demonstrate the power of this. I'm going to assume that you are a a husband and a wife, one of you is making a big salary. I'm not going to say if it's the husband or the wife, because if I say it's the husband, I'm going to have people say, well, why not the wife? If I said the wife, people are going to say, why not the husband? I don't care. One of you are making a big salary. One of you does not have a job. Now you decide to go out and invest in real estate. Here's what happens. You want to go out, let's just assume that it's a single family house. You're buying this property not to live in yourself, but you want to rent it out to another family. So you want to get into the rental property game. Well, assuming that you buy this property for $500,000, and to keep the numbers simple, I'm going to assume that you're buying this property all cash, no debt, just for simplicity. You buy this property for $500,000. Now you're going to go rent it out. Well, let's assume you rent it out for $5,000 a month. That is $60,000 a year in rental income. But that's not all profit. It's actually rental revenue, because now you have to pay expenses. You have to pay for your property taxes. You have to pay for insurance. You have to pay for the maintenance, the management, and everything else in order to run this property. So let's assume now that you net $30,000 a year after paying for all of your expenses. This is the net income. Now you have to pay taxes on this $30,000. Well, as a licensed attorney who's not your attorney, what I can tell you is one of the nice things about real estate is real estate has a lot of tax loopholes, or at least that's what some people call them. It's really just a tax write-off or a tax rule that allows you to qualify for bigger deductions. One of those loopholes, rules, deductions, whatever you want to call it, is called depreciation. And what depreciation says is that you can take a piece of the value of the real estate and write it off against your rental income every single year, even if your property goes up in value. So here's how it works, and then I'm going to show you how this can get very powerful. The way you do this now is you find out the value of the property, because when you bought this single family house, some of the money went to buying the land, the other part went to buying the house. If we assume that $100,000 of this $500,000 went to buying the land and the other $400,000 went to buying the house, now we can do a little bit of math. The IRS says that if I'm buying a single family house as a rental property, I can deduct 127.5 of the value of the property each year. This is not a number that you have to calculate. That's just what the government says. That's what the IRS says. So you take 1 divided by 27.5 and you multiply that by $400,000, which is the value of the property, not the land, which tells me that I can take a $14,500 write-off on paper on my taxes, because that's what the government says. So instead of paying taxes on $30,000, I'm going to pay taxes on about $15,500. So you still have a taxable income, but it's less than what you thought. But this is where things can get even more interesting if you have a good accountant and you have a good attorney. Because now what you can do is something called accelerated depreciation. Right now what we're doing is the standard depreciation. This is what the government allows you to do no matter what. They allow you to take this standard depreciation, which is 127.5. But if you get a good accountant and a good attorney, now you can do something called a cost segregation study. And now you can depreciate different pieces of the property at different rates. What does that mean in simple terms? Well, that means now instead of depreciating $14,500 in the first year, now maybe what you can do is you can depreciate, I'm gonna cross it out, you can depreciate, let's just call it $100,000 in year one, because remember, $400,000 was used to buy the property, $100,000 for the land. And so now instead of waiting so long to get all the depreciation, what if you could get $100,000 in year one? Well, remember, you only had $30,000 in income. If you take $100,000 paper depreciation, that means you have a loss of $70,000. But remember, you have $30,000 in the bank. It's not an actual loss, it's just a paper loss on paper. You're telling the IRS, hey, I lost $70,000, when in reality you have $30,000 in the bank. Here's what that means and how some people are using this strategically. Well, the first thing is you don't actually pay any money in taxes here because, well, you have more loss than you have gain. Now what some people might say is, well, if one of the spouses, doesn't matter if it's the husband or wife, if one of the spouses has a big salary, can't it take this loss and take that against the salary? And the answer is maybe. Because in order to do that, you have to qualify for a special rule. Because normally the answer is no. This is considered passive income. Your salary is considered active income or ordinary income. They're two different buckets. And what the IRS says is you cannot take one bucket of income, you cannot take this passive income, which is the money you make from your real estate properties, and use that to offset your active income, your ordinary income, your earned income, which is the money you make from your job. So the normal answer is no. But there's a reason. Let me show you something. There's a reason why the federal income tax code, I have a copy of it right here, is more than 2,000 pages long with 12-point, maybe 10-point font. There's a reason why this is so long. It's because there's a lot of potentials and hypotheticals. So let's go through one more hypothetical. The IRS tax code has a special designation called real estate professional. And if you are a real estate professional or you classify as a real estate professional, you can now take this real estate loss and take it against your active income. So now, let's piece this together. One of you are earning a big salary because you work a job. One of you are not working. If the person that's not working is now involved in the management of the property and involved in the real estate business now because now you're managing your portfolio of real estate, well, now you could qualify as a real estate professional. Now, if you do want to do this, please get a good accountant because there's a lot of different hurdles you have to meet. You have to meet a certain number of hours that you have to work. You have to log certain things. I'm not going to get into all those little logistic stuff in this video. Just know if you want to do this, get a good accountant. So now the person that's not working becomes a real estate professional because now you're the one that's in charge of managing the real estate and you're the one that's in charge of this building this real estate portfolio. Well, let's go through the same scenario. Now, if you are a real estate professional, either one, I'm not pointing at one, you are a real estate professional, you lose $70,000 on paper because you did this accelerated depreciation, you have $30,000 in the bank. You have a negative $70,000 loss. Well, now you have the potential to take this negative $70,000 loss and offset that salary because you're married. You're married filing jointly as a couple, and so now you can qualify to take this real estate passive loss against your active income. So now you've made an extra money, but you're paying less money in taxes. Yes, this is something that wealthy people do. Yes, you want to have a good accountant. And yes, this is something that maybe you can consider if you are interested in investing in real estate and you could potentially qualify for this. But again, get a good attorney, get a good accountant. Underrated investment opportunity number 3 out of 3.5 is investing for cash flow, specifically dividends or rental income. Now, the best way for me to explain this is honestly just a personal story because I was fortunate to start investing for cash flow a number of years ago. First, I started investing in rental properties, and then I started investing into dividend-paying ETFs every week. I created a system where every week I would invest my money into a portfolio of ETFs, the bulk of which were dividend-paying. So high dividend yielding funds or dividend yielding ETFs. And the way that it worked was I would invest money every week, and I would get very little dividends for the first few years. Like it was negligible. It was no money essentially in dividends. But then over the years, what I kept doing was I would reinvest the dividends that I would get, and I would continue to keep investing more money. And then what has happened now is, number one, markets have gone up. So the value of my portfolio went up. Along with that, number two, as companies have made bigger profits, they've also paid out bigger dividends. Along with that, number three, my portfolio of these dividends have grown bigger. And now the income that I'm getting from my dividends, we'll talk about this separately than the real estate, has grown quite a bit. And it's becoming now a real source of income. It took a long time to get there. It started very small for years, but now it's becoming a real source of income. The reason why I'm saying this is because dividend investing is a long-term game, but it can add a new stream of income for you that's pretty passive if you're willing to stick with it for the long term. Because the problem that so many people have with it is if a fund is paying, let's call it 3% a year in dividends, and you have to buy this fund or stock or whatever for $100, if you invest $100, you're only making $3 over the course of a year, which is not that much money. But if you do it for a long enough period of time, here's what you're doing. You're not just buying one share, you're buying one share a week 1 share every 2 weeks, 1 share a month, whatever you want to call it, right? We're going through a hypothetical. And so now you keep buying more of this thing. You're buying more of this thing every week, every 2 weeks, every month. But then a few years go by and this initial share that you bought is now worth, let's call it $200 just to have some fun. Well, not only did the value of this fund go up, but instead of paying $3 in dividends, it's still paying out a 3% return, which is now a $6 dividend, right? Because a 3% return, 3% dividend on $200 is $6, but a 3% dividend on $100 is just $3. So now you've accumulated more of these things, right? If you buy one of these every single week, well, now after a year, you have 52 of these shares, 52 things that are paying you $3 a year. Well, after a few years, they might not be paying you $3 a year. They might be paying you $6 a year. But along the way, you keep accumulating more of those things that keep paying you a little bit of income. That's the way that you can succeed with this, where if you look at it over the span of 10 years, you can really start to stack that income. And the nice thing about this compared to real estate, I love real estate, don't get me wrong, but the nice thing about this is it can be completely automated. There are apps out there, you can check my description if you're looking for apps that can help you with this, but there are apps out there that specialize in automating your investments into things like index funds or ETFs or mutual funds. And now you just find a few funds that you want to invest in and you set it and forget it. You keep investing when you're going through a recession. When the 2020 pandemic hit, markets fell by more than 30% in a matter of days and a lot of people were selling. But that's actually a great time to be buying. Yeah, you gotta cut through the noise, cut through the emotion because everybody's panicking, everybody thinks the world's gonna end. But if you can keep buying, now you're buying more shares at a discounted price, which also give you the same dividends. Now, yeah, when you go through a recession, because we will go through another recession, we've seen 16 recessions in the last 100 years, we're gonna see more recessions. When you go through the next recession, people are gonna panic, people are gonna freak out, people will lose money, and some companies will stop paying dividends. And that's why it's nice to do this with funds as opposed to individual companies, because a company can go bankrupt, but that fund can kick out a company and put another company in, so you have a little bit less risk. And so it's you now managing how do you want to play the risk, how do you want to play the return, right? We're talking about risk versus return. Higher risk, higher potential return, but I still want to figure out ways that I can lower some of that risk. And there are ways to lower some of that risk by doing ETFs or index funds as opposed to individual companies. There's ways to lower the risk by investing in a financial education. The risk never goes away, but it's just finding ways to mitigate some of the risk to find the return that you want. I like cash flow. That's just the game that I play. Maybe you hate it, that's fine. You can say, Jaspreet, stop rambling about cash flow, that's fine. But you gotta understand the game. So now we've talked about how to invest your money in the stock market by looking for where the money is moving and to find more unique and niche opportunities there, as opposed to just investing your money into a broad basket fund. I'm not saying you shouldn't invest your money into the S&P 500, just an alternative for those of you that potentially wanna be more involved. More risk, more potential return. Again, if you wanna stay up to date on what's happening in the financial markets, Market Briefs can help you with that, and I have that link for you down in the description. Number 2, we talked about investing in real estate and how you can maximize potential tax benefits by investing in real estate. Again, you want to have a good accountant, you want to have a good attorney to help you with that. Then number 3, we talked about how you can invest for cash flow. We talked about investing in cash flow through dividend-paying stocks, dividend-paying ETFs, and we also talked about real estate very briefly, but I also talked about that number 2. This leaves us with 3.5. And the reason why I call it 3.5 is because this is now investing into your own business idea. It's not really going out and passively investing your money into a different asset. This is you building your own asset. And this is a lot of work, a lot of time, but for the right person, this can create a great investment opportunity for you. But there's a few things that I want you to remember. Do not go out and start a business if your goal is to have more freedom. Do not go out and start a business if your goal is to make a lot of money very quickly. And do not go out and start a business if your goal is to have less stress. Starting a business takes a lot of work. It takes a lot of time. It's gonna create stress and it's gonna be very busy. But if you love that idea, if you don't like the job that you're working on and you have some sort of business idea that you wanna do, go for it. You only have one life to live. What's the worst that can happen? Start it on the side, start it in the evening, start it on the weekends. Just try something. You got nothing to lose. Now is the best time to start, and there are more resources than ever to start a business. If you feel like you're an entrepreneur, go out and do it. If you have that itch, go out and do it. Invest some money into it. Invest some time into it. So what if you lose? So what if you lose some money? So what if you lose some time? So what if people make fun of you? It's going to be a part of the process. I guarantee you're going to learn something. And if it doesn't work out, at least you're not going to be stressed wondering, what if I started a business? And if it works out, well, great. Starting a business is very hard. I know a lot of people sell a lot of crap on the internet telling you, oh, just start this FBA business, start this e-commerce business, and you're going to make 6 figures in 60 days. It doesn't work like that. Okay, starting a business is hard. It's very difficult to grow a business, but if you put in the work, it's very possible. And that can give you infinite returns. So high risk, high potential return. If there's something that you're interested in, I want you to go out and try it. If it's not something you're interested in, well, you have a lot of other investment opportunities as well. Now that we've come here, I want to hear from you. Which investment opportunity do you find the most interesting? Is it investing into the stock market where markets and money is shifting? Is it investing into real estate, particularly for tax benefits? Is it investing in cash flow producing assets? Or is it going out and starting a business? Let me know your thoughts and why down in the comments. I'm looking forward to reading what you have to say. Our economy is going to change in 2025, and in this video, I want to show you how you can find the investment opportunities that most people are overlooking. Take a look. President-elect Trump is entering the White House in January, and he wants to make some sweeping changes to our government and economic policy. Let me show you why this matters. In 2024, the United States